supply. Here is my supply. So I'm expecting it push price down, but immediately price got pushed back up. Reason being there's more momentum to the downside than the upside. Yeah. There's also another zone here. It's another zone here. What is this? Boom. You have to understand that there are two types of order blocks. Actually, no, that's actually three types. Sorry, there are three types of order blocks. Is what you call the what is this? Where you see multiple wicks. Where there are multiple wicks in an area, there'll be an order block there. Where there's consolidation, there'll be an order block. And where there is where price has made huge momentum, like price has pushed up to the upside, like here, there's created an inefficiency. An inefficiency is basically what you call a fair value gap. Price moves up and then creates a gap. Automatically, price is going to come back down to that block. Now here is a demand block. Yeah. Now, remember, you have to plot the previous candle before the sharp move. Yeah. The high and the low, the previous candle before the sharp move. Let me plot it properly for you. Remember, it's just a zone. It's not an actual place. It's just a zone because we do not know the exact area where they place their orders. It's just a zone. As you can see here, it's a perfect example. This is a valid order block. Price pushed up, and what happens? It came back down to here, and once it came back down, boom, it got pushed up again. But what forced it down? What forced this price to come down? Here, around this area here. As I look towards my left, you can see this. Are you seeing this? There was an inefficiency here. Price got pushed down and it came back to fill these orders and continued, and it got pushed back down. And then all of a sudden, here, from here, price got pushed down and came back up here to fill up the orders that were left behind. And then eventually, once the orders got filled, price got pushed back down. And then there was also orders here. There's some rich guys who thought, hey, this is a good price to buy, just push price back up. It came back to this order block. And then also, there were orders, sell orders here. Price got pushed back down. Then these guys here push price back up, and they broke this order block. They broke it, but they failed to what? To think this one here. This is another order block here. A very good one here, as you can see. But you can change the colors. I usually put my thingies on red, supply areas for red, and then my buy areas in green, so I don't confuse myself. And also makes your work look a bit neat, colorful, playful. Yeah. So The reason why I've told you to first look at market structure just gives you a whole understanding of how price moves. But what drives the market? What drives prices? Yeah. What causes market structure are orders, or what you call liquidity. Liquidity is just basically orders that are placed in the market. Now, these are caused by the market makers, the rich people, yeah, those millionaires or billionaires, all those institutions and banks. They're the ones that create market structure. So may I trade with along? I go with them. Once I see these moves here, I just look for my zones. My zones are what? The order blocks. Bit supply, bit demand. Now, if you have go to market structure, you've identified when a downtrend or uptrend, just mark your zones. Mark your zones. Now, like here. Now, another thing, before I continue, I want to tell you now, if price breaks an order block, now like here, so the block here was broken, and price just continued further down. Yeah, it's already become invalid for me. So, but you can see here, where is this? Here, this move here. What caused this move here? There were large orders here, around here. Yeah. So the previous candle before that large move, you mark the high to the top on the previous candle. Then you have your what? Supply area. Uh-huh. So price has moved, has made from here. Here, there's support here. Price got supported here. Reason being, if I'm to go back in the past, there must be a demand block around here. Let me first go to the daily. Go to the daily if I can see it on the daily. Will I see it on the daily? Huh. Like I said. Oh, wow, this is very, very well and good. So, but this block here has already been what? Mitigated. A mitigated order block is one that has already been filled up. But then people will tell that mitigated order blocks are not good because they've already been filled up, but no one is 100% correct when it comes to trading. So price will do what price wants to do, because what drives the market is price will move basing on orders. So now these guys have pushed price to this point here, yeah, and around this point here, there's an order block here. There's another block here which got filled up. Got filled up. Like I said, it doesn't have to be, price doesn't have to be at exactly where the order block is. It could be near or around. Yeah, it's just an area. We do not know where the exact orders were.
Mr. Joel,
Yes.
as you're still
I'm here.
there,
Uh-huh.
there's I heard that like a bullish order block. It is the last that they can like if it's a bullish one, it should be the red candle before that move.
The red candle. It
But
is
as
always
I see here, you're marking it in the green. So how is it?
It is the previous candle before the move.
So it doesn't matter the color of the candle?
It doesn't matter the color of the candle. It is the previous candle before the move. You see here? This one is bullish, yeah? You see this, eh?
Yes.
This one here. This one here. This one here. You're seeing it, eh?
Yeah.
Yes. Now, before this move happened, there were orders here. There were orders. There were orders around here that pushed price up.
Okay.
And then what happened when price got pushed up? What's wrong with this thing? Sorry. Push price up, and then price comes back down to get the orders that were at. It created an inefficiency or a fair value gap. So when price moved up sharply, it had to come back down to fill these orders because it didn't have enough momentum to continue. When it came back down to fill the orders, boom, we got this. We got that. Now, there's also another one here. There was also another one here. This one here. But this one has been what? Mitigated. Have you seen this? What's wrong with this thing? Okay. This one here. Have you seen this? Orders were placed here. Push price up, and then it came back down, and then boom, it continued. And it continued. It's always the previous candle. Okay. It's always the previous candle before the sharp move.
I've seen some instances where you find like a candle pushes up, a huge one, and another one immediately again pushes down almost to the same size.
That is manipulation. You know, these guys here, they can't place their large orders at a go because they have large sums of money. Yeah. So what they do, they have to create areas of interest where they can put in their money small. In order for them to place their orders, they first have to sweep liquidity. They first have to take you guys out of the what? Of the market. So if someone enters from here, yeah, sorry. If someone enters from here and he sees price is going and he gets excited, let's say he has entered, where is this? Where's my long position? Yeah, he gets excited and he enters from there. And then he makes his stop loss. Of course, he doesn't want to lose a lot. He makes a tight stop loss. For me, seeing the big move coming, what happens next? Of course, they'll come and take out your money. They'll take out your money, and this will give them what? Drive. Push the market further upwards. So it's trading. One thing you have to understand about trading. Trading is a give and take. You cannot place an order in the market without someone selling, and someone cannot sell without someone what? Buying. Do you get that? So in order for them to place their orders, they first have to take you out to force liquidations. Those are sales. And then they enter. Are you getting that?
Yeah.
So they force you to sell by hitting your stop loss, and then they've gotten a good price for them to enter, and they continue. Price continues. Yet the ones who placed large orders around here, mind you, here, this is an order block here, around here. They place large orders here to trick people, to put their entries around here, and then what happens? They'll sweep you out. They force you to sell, and then they place more larger orders because it's a good price for them. It's all manipulation. So one thing you have to know, okay, I was talking about what? Order block. I was talking about order blocks. Now this is the daily time frame. It's the daily time frame. Let me go to the 4 hour. Go to the 4 hour where we are. Okay. Like, where do you find these order blocks? Like I said, you find these order blocks where there is serious momentum. Yeah. Now, like here. Yeah. Okay. If you can start from, if you're a 4 hour person, start from the 4 hour, mark your zones in the 4 hour, your order blocks in the 4 hour, then you go down to a lower time frame. If you are a day trader, start from the 4 hour going downwards. If you are a scalper, you can start from the 1 hour going downwards, or 30 minutes going downwards. Yeah. But if you are a swing trader, you can start from the weekly towards the daily. Because swing traders can stay in the market for 3 days to 5 days to a week. The swing traders. Yeah. Or some can even start from the monthly, then they go downwards too. You mark the zones in the monthly, then they enter in the daily. But if you're a day trader, you can start from the daily, then you mark your zones in the 4 hour. Yeah, the daily just gives an overall market look, how the structure looks like, what the trend is like. Then you go to the 4 hour, you mark your zones, and then once you see price in your zone in the lower time frame, automatically you may look for chart patterns. Look for chart patterns, but before you get those chart patterns, in the 4 hour, after marking your zones, there's something that you have to first look at. Now, like here, let me come here. Let me see here. Let me first go to the 1 hour and I see to confirm. Yes. Now, like here. Yeah. So, our area here, once price hit this area and closed, this is a what? A bearish chart pattern. This is a bearish inside what? Bearish inside? No, sorry. Can I call this is a shooting? Am I right to call it a shooting star? I'm right to call it a shooting star, right? This candle here.
Gravestone doji.
This candle here. It's a shooting star, right? So once I see that, I go to the 1 hour and it's in my zone. What am I looking for? I'm looking for a double top. I'm looking for a double top. And look what happens. This is the 1 hour. The first top, the close of the candle, to the highest point of that candle. That's my area of interest. If I make this purple, my area of interest. Yeah. Let's remove this. Now, I want price to close within this area. I want price to wick within this area. I do not want price to close above my box. If it does that, it has made another higher high. If it closes above, it has made a higher high, and maybe price is continuing further. But I want price to dance around this area, my box here. So it made the first high, it came back down, made another high. But and then it's supposed then price pushed further upwards, and then it wicked, it came back down drastically. So what I am seeing here is something like this. Price has gone up, and then it has come back down. Overall, we made a low. Made a low. And then it has gone back up. Within my box. And then what happened? It has come down. So now, what am I waiting for? I'm waiting for price to come back up. To touch my area of interest, the neckline. My neckline should be around here. Remember, if you're selling, if you're selling for double top is a bearish sign. If you're selling, consider the wick. And then price is going to go down. Now, let me first mark my neckline here. Mark my neckline. Lowest point is around here. The lowest point to the double top is around there. Double or triple top, it's around there. Yeah. I go down to the 30-minute and see if maybe we would have got this move here. Would I? Would I have got this move? No, I do not think so. I do not think so. Let's go to the 15. Let's see. I've got this move. No, I wouldn't have got this move. I wouldn't have got this move at all. Because why? Because price did not come and touch my neckline. Price had come and touched my neckline, I would have put my sell order here. And I would have continued with it downward. The price didn't come and touch my neckline. So it would have been a mistrade.
But the first was 4 hour.
Yeah,
I saw a fair value gap there. I think that's where the price came.
Yes. Yes, you're right. You're right. But for me, when I'm doing this, because I'm looking for, I follow chart patterns. Now, someone who understands, and you're right. You're absolutely right. If you have a deeper knowledge of trading, for you after creating an inefficiency here, price has to come back and fill the orders that are left behind, and price continues downwards. You're right. But for me, according to my rules, because I follow chart patterns. Yes, it has made a double top or triple top, but price hasn't come to my neckline.
You see, even here, they took this fair value gap. The price came back here. And
yes, you're right. But for me, I wouldn't, like I said, I have to follow my rules, because the neckline is my best price if I'm to sell. I don't want to sell below this neckline. I want to sell at the neckline. Because when you're selling something, you want to sell at a higher price. Now, the neckline is my equilibrium. That's where I want to sell at. I don't want to sell below the neckline. I don't want to sell above the neckline. Although it would have been nice if price had come back until the way here, and then I enter. But I have to select my Fibonacci. I'm sorry, I'm using so many things. I'm even confuse you. But if you bring the Fibonacci, this move here has broken the neckline. Yeah. As someone who's selling something, you want to sell your price? You want to sell your product at a higher price. So it would have been better if this price here, for me, if price here had come all the way to my 38.2 area or 0.5, the 50% area. But it stopped along here and continued downwards. So this trade I would have missed it if I'm following chart pattern. Someone who's doing ICT or CRT, I think they would have caught this. Or someone who's just doing who's doing what? Someone who's just following the basics of is very much okay for me. Now let me go to the current one. What I know, this is the daily zone. It's the daily zone here. But I remember because my analysis is done in the 4-hour. My analysis is done in the 4-hour. I have to consider the 4-hour because the daily has given me an insight that around here is the demand zone. But my analysis is basically done in what? 4 hours. So I would have marked this point here. Would have marked this point here, and then I wait for price to come back down to it, which it did. Why did price come back here? Why did price? Oh yeah, because there's well actually another thing that I keep on forgetting to tell you guys. The zones. One ways to identify the zones is when price pushes upwards aggressively. That can be your zone. Another area is where there are multiple wicks. Yeah, where there are multiple wicks can be your zone here. Like I did this. I'm just following the wicks. There are multiple wicks that can be a zone. Another area is where price is consolidating. Yeah, where you see price is stagnant, not moving. Then all of a sudden, boom, price pushes up. Not like here. You can take this as a consolidation because price was stagnant for quite a bit around and then just pushed back. It pushed up, then it has come back down where it pushed to the demand zone, and it has given us on the 4-hour. It has given us. Let me see. Let me mark this. When I go to the lower time frame, let me mark this. Go to the 1 hour. Yep. Okay. The 1 hour, we're seeing a double bottom. Very clear. Double bottom. I think, Carol, you shared this with me in the afternoon, right? Hey. The neckline will be here. It's a double bottom. Draw like a box, just the first bottom to the wick of that first bottom. If I could first remove this, it's confusing. Now, double bottom rules. The double bottom rule. You want price to make the first bottom. So you draw your box at the close of the candle to the wick of that first bottom. Now, what we want is price to dance within this cap box. We don't want to see price close below this box. If price closes below, that has made another lower low, which is an invalid double bottom. So what we want is the price to close within the box, price to wick within the box, or even outside the box, but we don't want it to close below the box. As you can see, price has made the first bottom here. It came up and then got pushed back down. Got pushed back down. And then it broke out of the neckline and came back down. And then boom, push back. So if price, you see this, and price has broken the neckline. Price has broken the neckline. What you do, actually, before price breaks the neckline, if you see price has been rejected, the second bottom, price is pushing back up. There to be a confirmed for you, price is pushing back up. You just mark your neckline. And then what you do is you place your limit order on the neckline. Put your limit order on the neckline. Remember, we are taking a 2%, which is fine. Risk reward ratio of 1 to 8, which is okay. And then your stop loss is 1.1, just below the low of the previous candle. It's a 1.3. I usually take like a 1.7 just to be safe. Yeah. And take profit 2%, which is okay. So once price has broken the neckline and then it comes back down, not retest the neckline, my limiter has already been taken up. And when I start seeing it pushing upwards, what I do is basically I push my stop loss a bit. Then there I let price go up. And why am I taking 2%? Don't be greedy. Don't be greedy. Trading is about winning a trade. It's not about getting this amount of money in a trade. No, it's about winning the trade. How many trades can you win on a daily? You take this, the risk reward ratio of the 2 is good. That means if you had you've doubled your money. If you had $50 here, you're trading with $50, and you're risking 1.7, not $50, and you take profit with what? 2%. So you've doubled your $50, which is okay, man. Very good. You don't have to get greedy. Just stick to 1.3 risk reward ratio. If not, just do a 2% stop loss, 1.7. You'll be okay. And if you're doing this on a daily, over a week or in a month, you find that your money has really multiplied. But just remember, how do I get these trades? I get them in the 4-hour in the demand zones. Order blocks. The order blocks are essential to me. Because now here, I would have been, because no price, if I look in this, the price has made, I would have stopped here. Where is this? Huh? My stop loss would have been exactly at around this point here. It would have been a 3%. Around there. Why? Because this is a supply zone here. Let's come from that red candle to there. That's a supply area. When I've taken that, and I'm happy. And I'm very okay. Yeah. So any questions?